All right, so thank you very much, Luke, for joining me, and we'll wait for a while for other people to join the live stream. But meanwhile, for a record, I will just introduce you a little. So Luke Havard is an experienced founder, investor, and advisor, helping the founders of high-growth SaaS and e-commerce businesses to prepare, value, and sell their businesses for the best possible terms. Was the good introduction?
Yeah, for the best possible price and terms.
All right. So, Luke, tell me, how did you get into this business? Because you're not technically a founder, but you deal with a lot of founders on a day-to-day basis. So, tell me, how did you get into this business? Because I think this can be pretty interesting.
Yeah, so technically, I'm not the founder of this business. But I've been involved in lots of different types of businesses. I've started my own businesses. So I have been a founder. Granted, it wasn't in SaaS businesses or e-commerce, but I've been involved in lots of different types of businesses. I've been involved in consulting businesses, agency businesses, so marketing agency. And, in being involved in the consulting business, what happened was I was consulting with a lot of different businesses. And so I saw the whole spectrum of businesses, from product to agency, consulting, marketing, software. And, you learn a lot by being involved in lots of different types of businesses. I've been involved in online businesses and offline, and both types as well. And that really taught me an awful lot about how businesses work, and, what is important to a business being successful, and what can be a detriment to a business, and how businesses fail. And so what happened was, when I was consulting with businesses along the way, I felt like, there's been occasions where I've made businesses a lot of money, and I was getting paid a fee, and that was nice, but I saw them making a lot more. So it came to the point where I wanted a piece of that upside that I'd created. So what I did is I ended up investing in some of those businesses. So instead of being paid a fee, I said, you can either give me equity, or you can, let me invest into the company, so that instead of having to just take the fee and watch you create all the upside, we share in the risk and the reward. So if I don't help you create value, then I shouldn't get paid. And if I never didn't help people create value, so I was fairly confident in my ability to create more value. And so I said, hey, and if I do create you value, then surely it would be only fair that I share, in a little piece of that upside. So I kind of got into investing through equity investing, and then I've put in money to deals as well as an angel investor, I suppose you could call it. And then along that journey, I created a private equity, a principal private equity fund, which essentially was going out and buying up companies. And, started with smaller companies. Then it went into trying to buy up very, very large companies. I mean, we're talking hospital groups, things like that, in other countries. So I went and did that, and had some problems doing that, and learned the hard way that, you can do it on a smaller scale. And if you have problems, they're smaller problems. If you do it on a big scale, it can, destroy your life almost, and make you bankrupt very quickly. So I learned the hard way in doing that, but along the way, I was still working and advising a lot of SaaS companies and e-commerce companies, things of that nature. And I was also working as a partner with a business brokerage, because I understood from both sides of the table, how to be a founder and how to run companies and work with founders, but also how to buy companies. I understood what it was like as an investor. And that's a really big thing. And there's a really big, I think, misconception in the marketplace, especially for founders, is they really don't understand the psychology of the investors, the buyers of businesses. And a lot of the times, especially when you talk to SaaS founders, they don't talk about what's going to happen when they sell the business. They're not talking about exit. They're not thinking about it. And for me, that's a fundamental question you should be asking yourself all the time. Like, why am I building this business? For what purpose? To what end? I mean, the first purpose should be that you're solving a big problem and you're meeting a need in the marketplace. But what's going to happen? Like, what's the end result of you starting that business?
The end game?
Yeah. And so I can carry on talking about this subject now, or you can ask me some more questions first. I might be skipping
I have a few notes from what you just said, and I want to step back a little to the time when you were an investor, because I know that a lot of investors just have money and they want to put it somewhere. But as you said, you are actually helping these startups to make it, to make money and to become successful. Can you tell me a little bit more about how do you decide in what startup you invest? Like, what questions do you ask the founders, and how do you actually evaluate the opportunity for you and for them?
Good question. So yeah, I mean, you got to be looking at the business. I mean, from my perspective, when I was doing it, because it wasn't just purely about money I could put in. If I could put in my own money at some points, depending on the size of the deal, but oftentimes I was like thinking, well, actually, putting in money is not the solution that you require. Money is just one option, but actually what they really needed was strategy. They needed advisory. They needed access to network. They needed access to more customers. They needed better, ideas, vision. There was lots of things they needed. They needed, help just running the business. A lot of founders I speak to are really good, visionaries and product guys that have no clue about marketing or anything. And that's not their fault. That's just not their strength. And so oftentimes, I was looking at the business thinking, well, okay, how much time and energy will I put in, and what will be the return on that time and energy? Because if you have a lot of money, then time is your strongest currency. If you don't have a lot of money, then, then time can be, if you have a lot of time but not so much money, then obviously
I understand.
Money needs to be the currency that you're able to get your return on. So for me, it was at first saying, okay, if I'm going to put my time and energy into this, and I can bring some money to the table if it's necessary, but what is it that I need to do, and how much time is it going to take? How quickly can I actually add value to this business and actually get a return for all of us? Because I wasn't so concerned if I couldn't really add value. Then I said, I don't want anything in return. I want to be on performance, and I should be judged fairly for my performance. If I create great value, then I want to return on that performance I've created. But if I don't create any value, then okay, I want it to be quick. I want to know quickly that I can't add value to this business. So I would always be looking at, okay, who are the founders? Like what real strengths do they bring, and what weaknesses do they have? And do my strengths complement their weaknesses? So can I fill their holes,
Okay, so you're saying that a lot of founders are great product guys, but they have no idea how to run a business. It makes me want to ask a question, like, in which stage do you invest? Is it like pre-seed, seed, Series A? Because I believe that in a Series A, you actually need to know how to run a business as a founder. So are you more like early stage investor?
So at this point, just to be clear,
when you were investing.
So when I was more investing, that's a good question. I think I wasn't Series A for sure. I was more angel stage.
Okay.
So seed. But really what I was looking for is, I was looking for the stage where they definitely had traction. They could definitely have, proof of concept. There was definitely people buying what they were selling. And, it wasn't just a quick churn. People were actually sticking. And so I wanted to see that there was real evidence and validation of, the product and the service, and that this was something they could really run as a business. I mean, ultimately, people don't need to be genius marketers or incredible hirers of people. They really just need to show that, I can create an idea, and I can create, minimal viable product, and I can get people interested enough to actually give me some money and commit to, buying my product for a certain amount of time. And, if you can sell the idea before you make it, which I think is the lean startup concept, then that's a great place to be. And so there were quite a few people I was working with at some point back in 2015, I think, where they all had these incredible ideas and they had these amazing, products or services. And I was just coming in as the strategy guy and saying, here you are, here's where you need to get to. And let me help you create this journey. So I would bring in like the marketing teams, or I'd bring in, contacts, joint venture partnerships, so if there's a customer base over here and someone's got a great product or service, but they, don't currently provide this product or service, then I would introduce the two parties. And, you can accelerate that growth exponentially if you have, 100,000 potential users over here, and you can, get an introduction and someone's going to agree to do a promotion together with you for maybe a percentage of the profits. And so that way you're not risking marketing spend or ad spend or anything else. You're just using your service and their resource, their database to actually create traction in a bigger way. So obviously when you do that sort of thing, or even when I brought in marketing teams who could run, Facebook ads or Google PPC ads or whatever the case may be, they want to see something. They want to say, okay, well, what are we doing here? Like, what is it you have? Do you have customers? Do you have paying customers? Do you have people who are subscribed? Are they staying for more than 3 or 4 months? What have you actually got? And so I was looking for those types of things, and I was looking for like a real problem that they were stuck on. For me, it was always about, like I said, helping somebody to make it past the stage where they got stuck. So if someone's not stuck and they can do it themselves, then I don't need to be involved. But, oftentimes people are stuck and they just need to be honest with themselves and admit that, this is where I'm at.
I think I was actually talking about similar thing in a last interview, that a lot of people just fall in love with the solution. For example, with the technology, you could see it in January 2018 with the blockchain. There were so many useless projects built on blockchain because somebody saw a huge opportunity there. Let's do an ICO and we will make millions of dollars. And they were creating these products that weren't actually solving any real problem. And I see it often. I was doing it as well. That I just fall in love with some idea, but I didn't fall in love with the problem. And that was the main issue. And I spent like so much time and money and effort to building something, and didn't find a product market fit in the end because people didn't need it. All right. Last question about the investing. Would you prefer a company with 1 million users and no paying customers, or a company that generates $1 million but have like 20 users?
Good question.
I know it's quite difficult to answer because you need to know other metrics such as like growth and traction. But like, what would be like the first thing that comes to your mind when you hear this question?
Oh, personally, I'd go for the 1 million paying customers. Because if you can make 1 million with 20 paying customers, I think with at least my set of skills and other people I know, I could probably get 100 of those customers.
I mean, but after, Facebook had 1 million users and they invested back into the traction and then they made billions. But yeah,
that's true. That's true. But we're not deciding whether or not this company that's got the 1 million users is at Facebook. And I don't know. I mean, of course, if we had both of them right now with all of the metrics laid out, I might give you a very different answer. But on face value, I'm like, this is what investors will probably look at quite oftentimes. Of course, I talk to people all the time and they're like, yeah, I've got $1 billion idea. And I'm like, where's the money? Show me your money. And they got nothing. And I'm like, well, come back when you've made some money.
But they have a valuation similar like Giphy had $900 million valuation and they didn't make a single penny.
No, and I agree. I think that comes down to when someone gives you an evaluation like that, but they only get valuations like that when they got venture funding already.
Yeah.
There's a very big difference. If someone believes in you enough to give you, 50 million venture funding or whatever the case may be, Uber is a great example. I don't know what it's at right now. Is it 100 billion in valuation? I might be wrong. I don't check on it all the time. So if I'm wrong, don't throw hate, comments at me because I'll come after you. But the thing is that's the key right there. Look, Uber's like not even that profitable, is it? It's really not that profitable in relation to its valuation. But the key thing is that someone thinks it's valuable. Someone thinks it's very valuable. And I don't disagree that it's very valuable because it's got this amazing infrastructure and it's got this huge global reach. But ultimately, when I think you're first starting out, unless you are an Uber and those companies, let's remember, everyone likes to quote Uber, Facebook, let's name another big brand. Everyone likes to quote these big brands, but what are they quoting? They're actually quoting unicorns.
Yeah.
So do you know how many companies out there who have millions of potential users, but they're not paid users? There's probably hundreds of thousands of companies out there that have millions or hundreds of thousands of users that are not paid. Who cares? The only thing that really matters is whether or not that thing is really worth something in the eyes of people who are going to give you real money. So if it's worth something in the eyes of venture funds who will give you 50 million or 100 million, whatever they're saying they're going to give you, okay, now we're talking. And if you can actually monetize those users, then absolutely, it's very valuable. But how many of those users can you really monetize? I mean, unless you've got a monetization strategy like Facebook where they can run ads to it, I don't know, what's it worth? It's very difficult to decide. So I totally agree. I mean, I'm dealing with people who've got these companies. We can talk more about this. We're helping to sell software as a service companies for, a lot of money. We're looking at some right now that could be worth 100 mil. But the point is, there's a reason why, because they've got metrics to back up that valuation. And they've got, some of them have got a lot of users and, not necessarily all paid users, but they've got some traction. So yeah, I think that's the key thing for everyone to remember if you're listening. You're not Facebook until you're Facebook. And so let's get our head out of the clouds and back to, planet Earth, unless you have something really, really, really special. Like Facebook had incredible market reach. Like no one had what they had when they got that type of valuation. Same as Uber right now. Like these are anomalies. They're not normal. They're not the norm. No one else is, it's not like there are hundreds or thousands of companies like that.
Duplicate the model, basically.
Yeah.
You cannot duplicate the success. The model, yes, but the success, no.
Exactly. And they got the first move. You could say, oh, there's MySpace and there's all these other things like Facebook out there at the time, but they just had this different advantage. There's a number of things they had. I mean, they had, people like your Peter Thiel behind them. They had all these other investors who were backing them. They had this kind of network effect that got them, just to kind of spread like a spider web everywhere. They were in everything, and they had this reach, and they just had some brilliant people on board. So it's a very different question to ask, but I totally get your question. You kind of suckered me in there a little bit, but I still prefer on face value. If I had just 20 users and they were worth like $1 million to me in a year, I'd be like, if I could just do, if I get that to 100 to 1,000 to 10,000, yeah.
All right. Thank you very much for a thorough answer. Anyway, we have majority of our members are SaaS founders and marketing agency owners. So, what would be your number one question for and number one advice for a SaaS founder in an early stage company? Well, because you're dealing with a lot of SaaS founders in your current business, and what do you see that they are making the mistakes, which areas most often?
Good question. It's not a simple question to answer. I'll try and be concise. I think, like I said earlier, stop thinking just like a founder and start thinking more like the person who might want to buy you one day. Because the big mistake I see everyone making is they're just building and they're just focused purely on scale. So everyone I talk to is like, yeah, we're just scaling. We're going to raise more money. We're going to scale. And I say, for what? What are you scaling for? Why? Like, when's the end goal? No, we haven't got an end goal. Or it might be, oh, we're just scaling until we get like $1 million a month in, revenue, whatever the case may be. And I mean, for some people, it might be, I just want to get to $1,000 a month, or I want to get to $10,000 a month, or whatever. But the thing that they're all missing is, okay, so what happens when you get to that? What are you going to do? And then they say, oh yeah, when I get to that, I'll sell. And I say, why? And they have no answer. They don't even know why they're doing it. So, and it sounds like a very simple, question, but it really is a complex question. You need to build this business for a reason. You're solving a problem, but I always believe businesses are built better when they're built to sell, because you actually have a purpose and a strategy about why you're building this thing, and you build it better. For example, I think most people, they build it and they don't really know where they're going. They don't know the end result. They don't know the end goal. And so they don't think about the things they're building. They don't think about why they're doing these things. And they might think about just the short-term success instead of the long-term gain. So if you think more like somebody who might buy your company one day, you start to think about what's really valuable. So intellectual property is super valuable, and it can make your company way more valuable. I think with software as a service, especially, people typically only focus on revenue growth. and they don't focus on EBITDA or profit. I think you should focus on doing that as well, as if you can. The other thing to think about is that, you know, the one thing that makes SaaS really valuable, for me at least, and what we're seeing, is growth. So revenue plus growth, and, you know, trying to keep the churn as low as possible. So really focus on customer service and providing the utmost value so that customers stick as long as possible. Need to get that attrition right down. Need to do whatever you can to figure out what's hurting, you know, your customer lifetime value, and get the customer lifetime value up, get the churn down. So what we're seeing is, I'll give you some metrics now if you want, or I can wait till a later question. Your call.
You can continue. Yeah.
So if you want to know what makes, like, the difference in terms of value of a software business is quite interesting. So it all comes on size. So big is beautiful. You know, in the natural world, everyone thinks, like, for some reason, I mean, not me personally, I'm married to a Latina woman, so I like curvy. But most people like, they think that, you know, skinny and like small things are the best things. You know, it's crazy. But what you'll find is, in the business world, big is beautiful. So the bigger something is, the more value it is. And what I mean by that is this. So let's say you've got a company that is doing like less than $1 million turnover in revenue, is considered small. So under $1 million, the multiples could be quite different to over $1 million. And to give you an example, so if it's under $1 million, you know, it depends on, you'll be probably valued on your profit. So if you're a SaaS and you want to sell, and you're under like $1 million in turnover, you'll be valued on a multiple of your profit. So let's say you had $100,000 in profit, you'll probably get anywhere between a 2 or a 4x, 4 times on that profit. You might get more. It just depends. Again, it depends on the growth. If your growth is, if it's, you know, under, say, 40 or 50% year-on-year growth, you wouldn't be like really slow growth, but you're not going to be considered fast growth. 50% year-on-year or more is considered fast. And that will also potentially add more value to your multiple. Now, when you get over $1 million, what can happen is people stop valuing that company on a multiple of the profit, and depending on your growth, they'll start doing valuations on your revenue. So what will happen is they might, you know, good example of someone we were talking to recently, if you've got over, say, 100% year-on-year growth, and these people had like a lot over 100, I'm not going to say what, in case they're listening, but a lot. And they had $1 million in revenue, recurring revenue, and their churn was quite low. I think it was like, going to say like 2% a month or something. I mean,
it's really nice.
Yeah, ideally though, and this is B2B. This is another thing. B2B is more valuable than B2C typically.
Why?
Because businesses tend to churn less than consumers. So consumers, if you're dealing with consumers, what's going to happen is
they're more emotional than businesses.
Yeah, and if someone signs up for like just a Netflix subscription, they might cancel next month. It doesn't happen, I don't think, as much as that, because I'm a user myself, and I was subscribed for 2 years and I forgot.
Yeah.
Just totally forgot. I used the free trial and then totally forgot. And same with Spotify and all these things, you know, you just forget. But the reality is, when you're a business, if you create a really sticky product and it's something that's got to be integrated into the business, like an email CRM, like, you know, some kind of CRM like HubSpot, and you're a bigger business and it's got your email, it's got everything in there, it's got call functionality, yada, yada.
Yeah, I mean, Salesforce are great at this.
The more it's integrated, the more it's integrated, the more you make it really, really difficult to migrate out of it, the less likely you're going to churn, and the more value you're going to create. So
at the same time, you should make your product as easy as possible to migrate into.
Yeah, exactly.
Yeah.
Everything should be easy. Everything should be difficult on the way out.
Yeah.
Easy in, difficult out. So going back to what I was saying, so if you've got B2B customers and you've got like over 100% year-on-year growth, or, you know, over 50, but 100 plus is even better. Really low churn. I mean, when we say really low churn, we've got investors who'll say, I want, you know, 1% churn per month or less.
Okay.
For B2B. I'm not saying that's attainable for most people, but that's what they're looking for.
Mm-hmm.
And then they want like 100% year-on-year growth and, $1 million plus in revenue. You can get, we're talking to people right now who are saying, I'll give that company between an 8 or a 12x ARR.
Okay.
But that's not normal, because more oftentimes what we're finding is if it is, slower growth, maybe it could be $1 million in ARR, but it's like, 30, 40% year-on-year growth. Churn might be quite high. It might be 20 or 30% year-on-year or more. You're probably going to get a multiple on your EBITDA or your profit.
Mm-hmm.
And your multiple could be anywhere between a 2 or even up to a 6, which is still not too bad at all, because trust me, on an e-commerce, the multiple will be probably between a 2 and a 3x on profit.
All right. I'm afraid that we are way too technical here, which might be a little bit difficult for people who are just joining. Anyway, thank you very much for this thorough answer again. And people who are watching, please feel free to leave your questions in the comment section, so you can ask and we will answer them live. Anyway, Luke, you mentioned multiple times exit strategies for SaaS founders and for SaaS companies. What would you say that they are the most usual and most common exit strategies SaaS founders should think about while they are building their company to sell?
Yeah, I think
acquisition by a bigger company together with
so I'll give you an example. There's different buyers. So there's different buyers, and the value of a company will mean more to different buyers. Okay. So there are people, if you're a small SaaS, maybe under $1 million in turnover, you'll be bought by an individual.
Mm-hmm.
So someone who is an entrepreneur or someone who wants to be an entrepreneur, they're a entrepreneur, and they want to leave corporate and they want to jump into entrepreneurship. So they might want to buy you. Mm-hmm. If you're in the US, they can use an SBA loan, or they may have some money in their bank, or they might use the triple Fs, which is friends, family, and fools.
Yeah.
If you're bigger, and again, it doesn't necessarily mean that you have to be bigger in order to get bigger investors, but we have, I'm working on deals where they're, just under $500,000 in turnover, or in sales price. And we're able to, there are some smaller private equity funds. So let me give you an example for those who are not familiar with the terminology. Private equity, they're similar to venture capitalists, except usually they buy out deals. They buy companies rather than invest in them. They do invest too, but typically they're buyout merchants. So when you've got private equity, what you have is they're a group of investors, professional investors like I was, and they build a fund. And so it's other people's money. And it could be anything from, 5 million to, we've had private equity with $1 billion plus under management. And they will come and they will have like a shopping list. So they know what they're looking to buy. They're probably experts in that area, and they will look to buy a business with certain criteria. Hence why I'm saying they're looking for, certain growth metrics. They're looking for churn and, revenue and EBITDA sometimes. Some of them don't care about profit at all. Some do. Private equity do usually want to see some profit. Even if it's just a little bit, they want to see that you're profitable, And so what happens is you've got the next group you might have is another bigger buyer. So you may have another business and they want to buy as an acquisition, like you mentioned. So they want to buy your company to put it into their company. So they might want to buy some of the technology you have. They might want to buy your customer list. They might want to buy the product and the intellectual property. And so you've got these different types of buyers: individual, private equity, and strategic buyer. And they could be, again, it could be another relatively small software company, but maybe bigger than yours. It could be a giant company like Facebook or Google or Uber or whoever. It just depends. And they do buy a lot. I mean, I'm telling you, I know for firsthand, I know the guys who work with Google, and they're like, they're buying like 5 or 6 companies a month at the moment. But you won't probably hear about half of them. And same with Facebook. They're just buying up stuff like it's going out of fashion, and you'll never hear about it because it's not that cool. Maybe, you got the odd ones like your WhatsApps and things like that you hear about, but oftentimes they're buying companies you've never heard of. They're just small minnows in the grand scheme of things. So this is what happens. And what you need to do is always be thinking, who could potentially be my ideal buyer?
Mm-hmm.
If I'm building this, first you want to build your company to solve a problem and serve customers. And of course you want to make money from it. But secondly, you want to say, who would be the perfect acquirer of my company? Who's going to look at my company and say, wow, that would fit perfectly in our portfolio, or that would really add value to our existing customers, So Facebook, for me, there could be a number of reasons why they bought WhatsApp, but probably I'd say because of the users, because they had, just this really cool technology as well. I'm not saying that Facebook copied WhatsApp in terms of their call-in functionality, but maybe they did. Maybe they copied the messenger sort of flow. But they saw something they liked, and they thought it was worth I think it was worth $2 billion to them or something. I think that's what they paid for it. I'm not sure.
Yeah, something like this.
Yeah. So that's what you've got to think of. Even if you've got a small software company, I mean, if we, like I know for a fact, if it's the right type of deal, we could get anything from, 4 or 7 times your profit, or we could get anything from, 4 or even 15 times your ARR. And I mean, we're dealing with companies right now where they may have, I spoke to someone who had, I think it was like 11 million ARR, and we might be able to get them 10 times. So that's $100 million plus deal, right?
And do all these founders, excuse me, all these companies you deal with, like the companies you are going to sell, did they actually start the business with purpose of selling it? Because when I talk to some founders, or even when I was thinking about my exit strategy for my startup, I was like, it's like thinking about the breakup when you are on the first.
Yeah.
Maybe it's ego. Maybe it's that founders are way too romantic about their business.
Yeah.
But do actually all the companies think about their exit strategy once while they are building it from the start, like you are dealing with these companies?
Like virtually no one. So that's why I think, for some people, they may be like, this guy is crazy. Like, I don't even have any intention of selling my company. But that's why I think people should start thinking about it, because the likelihood is when it comes, they will be completely unprepared. And I'm dealing with people all the time who've got great businesses, but they're missing certain things that they should have done. And now it's not as valuable as they hope it would be. And they want me to make it more valuable. And I'm like, you need to go away for 6 months and do X, Y, and Z to make it more valuable.
Yeah.
And you want me to now, but Luke, we can just list it, or we can price it this. And I'm like, it's not worth this. It's worth, they want to sell it for 6 or 6.5 times their profit. And it's actually worth more like 4 times their profit. And they want me to be a magician and magically make it more valuable. And it can't, it's not ready to be that valuable because of certain things they're missing. So yeah, I think really when you start thinking like this, and here's the thing, this works actually for any type of business, but it works especially well for software companies. So you can do this for, any company, like an offline company, exactly the same. In fact, most companies in the world will never be as valuable as software companies. Never. They just can't be. But one thing
because of the margins.
Yeah, the margins, because of the recurring revenue. So that's another thing. People say to me, oh, I've got a SaaS company, but then I check and it's only like 20% recurring. And I'm like, well, how can you call it? Yeah, it is a SaaS, but it's not recurring traditionally. Like, they're doing one-time sales of stuff. Like, they're doing like, hey, you get this special discount right now and you can get lifetime value or lifetime access. And you're like, well, that's not a SaaS, is it? You're selling big chunks of it, and you can't upsell those customers unless you've got something else to sell them. So the point is, I think what happens with like an offline company, for example, if you've got a bakery, I mean, unless you can get someone onto a subscription of bread, it's not a recurring revenue. It's just a one-time sale, and you don't know how many times those people come back. I mean, a gym could be a good subscription company. So if you've got a gym, gyms can be, but do you know what gyms, like, here's a little secret. With a lot of these companies, offline companies, I know about the whole spectrum of the industry, by the way. It's like quite sad. I can tell you everything about different types of industry valuations. But if you've got a gym, I've heard this story. It's the same as McDonald's. they don't actually make most of their money, big gym chains, off the gym. They make it off the real estate.
Yeah, that's true.
Yeah. So what they do is they go, okay, we're not going to own all of these and operate them. We'll franchise it. So firstly, they get a fee from the franchisees. They may get 50,000 a year or 50,000 one-off from the franchisee. And then they go, let's buy the real estate on a loan or something, and then get the franchisee to pay the rent. And so they have guaranteed subscription rental income. Now the gym owner, hopefully they can get a good subscription of people and they keep paying every month or once a year. But I hear most times people are like, it's really hard to get people to stay in gyms.
Yeah.
So that's an example of like, what sort of multiple are you going to pay for a gym? Not much, like really not much, especially if it doesn't own the real estate. So when you come to a software company can be worth a lot of money if you've got a really solid subscription of users and that user base stays for a long time. You can just keep monthly growing more users and you're just growing like this. I mean, we've got people we're talking to with, I don't know, 500% year-on-year growth, 800%, 1200% year-on-year growth. Now, they've got like 2 million, 5 million, 10 million in revenue. Those guys are worth a fortune. They're going to be worth a lot of money.
I want to jump back a little because you said the software as a service company isn't the company who does the lifetime deals and LTVs. Like they give access for a huge discount for a lifetime.
They can do like a 1 year sort of thing, maybe to get people on, but they got to be very careful because when it comes around to subscription, those people might accidentally forget and just keep on, you can take the payment again, but sometimes they may say, oh, hang on a minute, I don't want to pay for another year, and they just cancel and you lose them,
I understand. Because I want to talk about, because we are actually helping SaaS founders like to create lifetime deals with PitchGround. And one of the reasons why they do it is because they just don't want to have a seed investor yet. So it's like a seed money for them. So they are not giving up equity. They will get quite a nice amount of money for a founder, and they can spend it on more development and more acquisition. So if it's not like main growth engine for a company, I think it makes sense. But yeah, there are a lot of SaaS businesses who are just working only on lifetime deals, and I think it's not healthy.
Yeah, no, I agree on that front, because I'm not like knocking, the kind of to get some seed money. That's a good idea. I think if you can, as long as you're not doing it like as a long-term strategy, because there are companies that I've spoken to and they have now got a recurring revenue element. But when we look at their breakdown of yearly revenue, so what you do when you just value a normal SaaS, like a small one, for example, it will be valued typically on seller discretionary earnings. So that means your salary, things that we can add back in. So we'll take anything you take, like salary, and put it back into the business. And then we multiply that. And that's where we come to a valuation. Okay, trying not to be too technical here. But then if you've got a bigger one and it's got a bit of profit, EBITDA, just call it profit for argument's sake. The one thing we see is they may have a few different things on their website. So they might have a monthly subscription. That's cool. That's SaaS. That's recurring revenue. Then they've got a yearly subscription. That's okay. That's good. As long as people keep subscribing every year. Then they've got this one-time offer as well. And so they're trying to make it really valuable to do the one-time offer. But the problem is they're only going to get that payment once. And those people keep getting the service for the rest of their life. Yeah. So that's when it becomes very confusing, because they're like, I make 500K in revenue a year, or 500K recurring revenue a year. And then you check and it's like, no, you don't. You make 200K recurring revenue. You got 300 that's on a one-time lifetime payment. And it's I think
it all boils down to thinking in short-term metrics. But these founders, they don't understand how to increase the lifetime value of their customers. So they maybe just want to make quick bucks. So they offer, they still keep offering lifetime deal with no monthly on the side. All right, we have a question here. how long have these companies been around on average? Those growth numbers are mind-numbing. I think Nenad is talking about the companies with 800% growth. And how long have them been around?
It depends. I'm looking at companies that are like, by the way, for the person who asked the question, who was the person again?
Nenad Jovanovic.
Hey man, nice to see you. It depends is the answer. I mean, we will really suggest to founders we're dealing with that they need to be at least 2 years old.
Mm-hmm.
So 2 years old, because investors are going to look for that kind of longevity. They want to see that, hey, how long have you been around for? If you're 6 months and you're trying to come to me, it's unlikely you're going to sell your business. You may be looking for venture funding instead of to exit.
Mm-hmm.
So in answer to his question, these companies, some of them have just been around 2 to 3 years.
Mm-hmm.
2 to 3 years old. They're not that old. You know?
So these companies are coming to you that they wanna sell.
Depends. Sometimes we've reached out to them for our buyers. So we've got two different arms as well. We've got buyers who come to us and say, I'm going to pay you a retainer to go find me a deal.
Mm-hmm.
And we work on the buyer's side. And other times founders come to us and we'll work on the seller side.
Mm-hmm.
But it's a different thing, separate. So if we're working for the seller, I mean, they could be, which is more common, they could be any age. They could be 2 years old. They could be 10 years old. I've dealt with companies that have been around since 2004, man. The original Silicon Valley companies. I'm serious. I was talking to a guy and he's like, yeah, I've been around since 2004. I'm like, wow.
So 4 years after .com bubble. That's crazy.
Yeah. I've seen people who've been around longer. I mean, 1999 or something crazy.
Software company.
Yeah. I mean, there's people I know who have been around since like SaaS was like, even the term was invented, you know, really, honestly. But then there's people I'm dealing with who are just 2 years old, 3 years old. Yeah, there's a lot of people who are around, you know, from different kind of different things.
All right. Thank you very much. I see that we don't have like any other question. Pedram was asking question. If you're seeing how the company is getting customers before investing in them, like what is their customer acquisition strategy? Does it really matter to you?
Ask the question again.
If you are selling a company for someone, do you actually check how they are getting customer? What are the channels? What are the marketing strategies?
Yeah, we check everything. If I'm selling a company for someone, we check everything. We go through, like, here's the kind of checklist. It's like, how old is the company? Is it venture funded? Yes or no? It's sometimes easier if it's not.
Why?
Because if it's backed by VCs, VCs want it to be more value. So what happens is, good example, normal company, trying to making up metrics here. It's $1 million in turnover, and it's had some VC funding, right? Okay. They want oftentimes VCs want 10 times on their money. It's always, every time I speak to a founder, they say, yeah, my VC says I need to get 10x.
All right.
I'm like, 10 times your profit? And they're like, no, 10 times my revenue. I'm like, oh, yeah. So every time, I'm not joking. So let's say the company's got 3 million in revenue. They want 30 million for it straight away. But you haven't got any profit yet. Doesn't matter. Now I can have the same company. It's 3 million in revenue. And it hasn't got venture funding, but it's got a little bit of profit, like $500,000. We could get 6 times for that. So very different. They're very different metrics. So when we look at those numbers, it's like, you know, how old is the company? Is it venture funded? What's your annual revenue? What's your profit margin? What's your growth, year-on-year growth? What's your churn? What's the web traffic like? How do you get visitors? How do you get users? You know, do you pay for ads? Do you get organic? Have you got great SEO? Do you do blogging? Do you have partnerships? Do you do conferences? There's a million different questions in terms of that. Then we say, what's the team like? Do you have talent? Do you have people that are virtual? So, do you have offices? Do you pay for offices? Do you have everyone dotted around the world? You know, are they contractors or are they employees? Are they valuable? Because that's another thing. Like, people might buy a company even like and factor in the value of the people in the company. So, you know,
I heard that like big guys such as Oracle and like really big companies are doing this, that they will just buy the startup and they're not actually interested in the product.
No, they don't care at all.
They need the development team. Because if you really do the math and you know that hiring a good developer in San Francisco will cost you like 6 figures. It's a crazy, yeah. So you're actually pretty okay for paying 7-figure for multiple developers.
Yeah, and if you've got the developers somewhere in, you know, Eastern Europe or in the Philippines or somewhere, and they are happy to work on a less than Silicon Valley rates, then already you spend $1 million on it, but you've got 10 of developers are all worth whatever, then you've already got your money back straight away. And if it has profit as well and a great product, you're winning all day long. You're laughing. So they're gonna want to look at your competition. Like, what's the obstacles to get into your market? Like, how can everyone, you know, have you got something truly unique? What are the barriers to entry? You know, if you've got barriers that make you unique, like moats, now you've got something really interesting. And then we ask, what's your exit? You know, what's your multiple? What's your valuation? You know, what are you looking for? And I speak to so many that go, I want 10x, I want 15x, I want 20. And I'm like, okay. So then I have to, like, you know, sometimes they're right. Sometimes they know they're worth a lot, and they are. Other times they need to be brought back down to reality.
Okay.
So, you know, that's what we ask. So I hope that answers the question for the person asking. We ask a lot of questions and we help founders. So one thing for anyone listening is we can help before you're even ready to sell. And I think it's better to be prepared so that you build the company in the right way. And then when you are ready to sell, obviously we can help to make sure that we prepare the business, we value the business, we find the right buyers, and we help negotiate the whole.
Look, we have a like last few minutes, and I jumped into you talking because we have a 90-second pitch in the end of every interview where you can pitch your business and like talk to founders here and talk to our members in the group. So ready when you're ready.
Cool.
All right, so I'm starting the stopwatch now.
Okay, so I think this is ideal for founders if they are looking for, you know, an exit. There's a couple of things. Maybe they're looking to raise capital right now, and maybe they're kind of already growing quite well. Maybe they're looking for a Series A. They should come and talk to us. You know, we've got access to some of the biggest investors in the world. And the thing is, if you go in to raise capital or you go and try and sell your company on your own, I guarantee that 99% of the time you're going to have real problems. It's very, very difficult. So, you know, you wouldn't go to a dentist, or you wouldn't try and pull your own teeth out. You'd go to an expert, a dentist, and get them to do it. So come to experts. Same thing when you're selling your company. You're dealing with expert negotiators in the private equity groups and big strategic buyers. They have whole teams that do this all day long. So you don't want to be going into there trying to do this on your own. You need people who understand what they're asking for and to help you navigate this entire process. So when it comes to selling your business, you need someone who knows how to value it, how to prepare it, how to find the right buyers, and how to actually sell it and get the best multiple price for your business. So that's what we do.
All right, you did it in 1 minute and 15 seconds. Awesome job. All right, Luke Havard. It sounds so posh.
Well, that's because I'm a posh guy, obviously.
say your last name, or no, say your full name in the
Luke
most posh way you can say it. Luke.
You want me to say it again? Luke Havard.
Havard. Okay. All right. Thank you very much, Luke, for your time. It was incredible interview. You shared so much value here, and I'd be very happy if you stay an active member of our community, because we have a lot of people interested in this type of topic, in this topic of like buying and selling companies, and basically like I think you can just answer a lot of questions about the SaaS products and about the marketing strategies and so on. So feel free to like reply and network with other people. And yeah, thanks again for joining, and I hope we will see each other again soon.
Yeah, thanks for having me. See you guys.
Thank you. Bye.